Now, I made a couple of videos about badly structured corporate models. This is a discussion of a badly structured project finance model. And I think this is geared for people who haven't done a lot of modeling. It's not for kind of expert modelers or anything else. It's if you're starting in modeling and you want to see not what not to do. I think it's easier to learn perhaps by looking at what not to do, and when you do it right. Here's the amazing thing. It is not only uh, uh, makes your model so much better in terms of the quality, in terms of the transparency, in terms of the accuracy, in terms of the presentation, but it also is far, far easier to do. So I'm going to introduce things. Now, this is a real model that I received. I disguised some things. I hope I disguised it enough. So there were a lot of circular references in this model, which was the first one that was a first thing that was really a problem. And then there was a summary page, an input page, and a cost page, and a revenue page. These are totally out of order. Working capital page, profit, loss, cash flow. Where's the sources and uses? Cost page. Oh, there's a ratio page. Oh, there's a. It's totally out of order. That's just a minor thing. The first thing to get going on this is I'm going to show you a couple of the circular references. Now, this is an ideal example of the iteration button not fixing things. Because I think I left this. If I go to options and formulas, I have the iteration button on, and we still have all these references. And still, now there are about 3 different circular references. One is related, and we're going to solve these circular references in different ways. The first one is such an idiotic kind of one. They said, let's take the contingency percent and let's put a maybe 5% contingency. I'm going to put that in. But then let's put the contingency as a percent of the total. Well, you don't have to do much algebra, really, to say, okay, and here's what I did. I showed kind of how to, just 1 minute, I'm going to have to pause. Okay, I put my website. On the website, I have a special little page on circular references, and I'm working on this, and I'm trying to make these different. And I said, well, look, if you get somebody's circular reference, model with circular reference, fix the easy things. If you have contingency, the formula is the total cost is the total cost times the contingency plus everything else. For some reason, and everything else is the total minus the total contingency. So we can just take everything else, divide it by 1 minus the contingency, and get the total. And then the next thing they had is a circular reference. Unbelievable. They put the average, the interest rate, as the average of the opening and closing balance. Never, ever do that. It's so much easier. I'm sorry I get emotional about this. It's so much easier to structure the model with monthly construction and quarterly or semi-annual repayments. That's why you do it. And then you assume, which is the right assumption, that the repayments or the interest or the construction or the drawdowns or whatever drives the debt balance, that comes at the end of the period, which it does. And then there are some circular reference associated with IDCs and all that. And the first thing is to do is to use our horrible copy and paste thing. And then after you use the copy and paste things, you put a user-defined function in. And I have tried to explain this, and I'm going to make a couple of videos that I hope are structured, FASTSSS, structured. Most important thing is structured. I'm going to try to structure my videos a little better. Okay? So if we want to, so remember the formula. The formula is everything else divided by 1 minus the contingency equals the total. So all you have to do to fix that circular reference is to, before this, put a subtotal. Okay, and then we can put our units in. Now this, while I'm doing this, this is so interesting. This was really interesting because, and I'm going to put it over here, the cost per kW was 800. This is a nice low cost. And then you say, well, let's get the total after contingencies. And then separate, do the interest during construction a little bit differently. I mean, I wouldn't include that as a total. You could make a little adjustment to the average and all that. So this total is the this one divided by, it's got to be a little bit higher than it, so it's got to be divided by 1 minus the contingency factor. And then the contingency is just the difference. And then you solve that one. And then we have a thing with interest during construction. Now I should structure this video a little bit better because I'm going to talk about, I'm just going to fix a couple of the circular references and then we'll to get rid of all these values. So then we had operating costs. Now what I did is I make a little comment, and you just press the comment button. Now the way this macro works is so easy. You just go. I did it here. I did it here. You just put a little range name with the true and false. You press Shift Control F3 to make a range name. You right click. You assign the macro to it, and you assign a little macro to the click box, and you assign the click box to the true and false, and you first put application display comment indicator. It's easy to find. There's no indicator. If the comment is true, then display it. So turn it off first, and then if it's true, turn it on. Okay, and each one. Now this output page, I just should show you. In the output page, put the sources and uses. Show what's going on during the construction. And put that the cost per kilowatt was only 800. That's the big deal. And in this one, all they're doing is repeating the assumptions. That sucks. Stinks, sorry. And then on IRRs, if you have any inflation at all, put the nominal and the real IRR in. And of course, they're all values because of the circular reference. And then the assumptions, just as we're on the assumptions page. See, I'm not structuring this right, but this is where it all starts. This is where all the problem starts. First of all, why did you put the DSCR really in the assumptions page? You could argue to do that. Secondly, don't put things on the side. Oh my gosh. Much more importantly, don't start putting finance. You put some of the operating assumptions and the dates are totally screwed up. Always put the first of the month. You need a common timeline. That is so important to get a common timeline. And you need the start of the month for everything. This number of days in first year is totally useless. And then you can put some stuff with the project cost. I don't care if you put interest during construction here, which you'll get from the other sheet. To get that, press Control square bracket, and then press F5 to get back to where you want to, and press Enter. Control square bracket, and where was our thing? Now I am going to put a 0 there, just right now, to start to try to fix things. Okay, we still haven't fixed everything at all. Okay, but that's going to be a copy and paste macro to fix things. Okay, and then it's starting to look a little bit okay. But then it's got the finance, and then how could you do this? You put the generation after the cost. In the model, here is FAS, structure the model so it makes sense. You start with the operations, then you put in the CapEx, and then you put the revenues. And why in the heck would you put revenues in each year when the revenues are just increasing by 2%? You really need to put each one of those in as assumption? Why don't you just put the first year price and then 2% in? Oh my gosh. And then you put the depreciation, and where is the tax rate? The tax rate is above all of this stuff. What you do is put the the generation in, then the revenues, then the O&M, then find some working capital because that's all in project IRR and free cash flow. Then you can put some depreciation stuff, then the taxes, and then some other crap about LCOEs. It's not crap, but the way they did it, of course, was idiotic. Now, okay, so we're going to go through the assumptions. Now, the first, this is laughable. It really is. The revenue page had some revenues and assumptions. That obviously should have been the first page. And where's the capex after that? Then you need the capex. When they did some degradation, this was way too complicated and unnecessary a formula, and this is a total crime. That this formula is different than this one. Oh my gosh. The formulas better be consistent across the page. Okay? And this one, if it comes from the plant load factor, here, I'm going to press Shift Alt C. No. Okay, and we need to open the generic macros, and this time I have to press the initialize, Shift Alt C. And let's make this the color option today. Let's make it green since it's a thing, and let's not include column A because he didn't leave a space. He. I'm not telling you who it was. And then we can kind of see where the numbers come from. Now I got rid of some of this, but this one, that's okay in a way. But show where it comes from. Now this one has an input, and you should put what caused the input. This is just a direct input, and then the tariff came from the input, so that's okay, somewhat. But do that, and never ever. For me, this is. I'm sure you do it. A lot of people do it. They put these merged cells in. The first thing I do is press Control A couple of times to get the whole thing, Control 1, and then go to Alignment, and if anybody put any merged cells, I take it out. It's disgusting because you can't just click on a column and click on an entire row or column. It really messes things up once you get to be a little bit better at this stuff. Okay, now let's go back to the expenses, which were, let's do the same thing. Control A couple of times, Control 1, let's take all this wrap text business and merge cells and business out. This shouldn't even be it would be better if they didn't even allow it. Of course, they'd never do that. And by the way, if you get these things that are different size, you can press Control A a couple of times, Alt O R, Alt A. That auto adjusts the size of the line. So at least it's still a mess. Now here's the biggest thing. Here's my comment on this one. That's unbelievable. First, the date. Oh my gosh. You need to put a common date facility. The biggest mistake I see in models is not getting the date right. And if you do not get the date right, everything else will be a mess. And you need to put the construction date in, and you need to put the date consistent with the repayment of the debt. And then you can do some ifs to your heart's content to fix it. Okay, so here is a perfect example of kind of this thing. What kind of formula is this? Can you understand this formula if you just look at it? It's a mess. And then it just gives you 365 or 366 days. Oh, how brilliant that is. And then they didn't use E-date, which everybody uses E-date. There's nothing wrong with E-date. Why you wouldn't use that? Just to get an annual date, you had to put this crap in? Well, I used to do that, so I shouldn't say. And then you have the repayment that comes from some kind of just 60 periods or something, and so they divide it by the installments, and then they have the opening balance and the closing balance, and then here's the crime. They did something where it's on the opening and closing balance. Just take the opening balance and multiply the stupid thing by the opening balance. And then you're going to get rid of a lot of the circular references. Not all of them, of course. And then the book depreciation isn't a complete messy thing. You need to compute the book depreciation kind of. You get pre-tax project IRR and then after-tax project IRR. And then eventually you're going to need to adjust the book depreciation and the tax depreciation, book and tax, by the IDC. And that's nowhere done. And then this is another crime. What a crazy assumption here. Put in the inflation rates. Don't have an absurd formula like this. Maybe this formula is okay, but it certainly isn't transparent. We've got in FAST. F is the getting the dates flexible. A is any semblance of accuracy. And then the interest expense. Oh, P&L inputs, wherever that is. This comes from some other sheet now. I thought the interest expense was just computed up here, but apparently it's not. Oh my gosh. Oh no, this is insurance expense. Excuse me, I couldn't read it. But still. Oh, no. Was that? Okay. You're right, that was a different one. Okay, then, so now let's go to the income tax calculation, which is still a complete mess, and still we have all of these. Now, one of the reasons we still have a circular reference is this was amazing. Now, working capital should be right next to revenues and expenses. Oh, come on. And if you got really fancy, you could put later on some working capital associated with interest during interest expense, but you don't have to do that because the model should be structured to see when you actually pay the interest, so there shouldn't be any interest payable. Here's what they did here. This is just such a crime. Okay, you can I press Shift Control E to get a couple of subtotals, and then we get a profit before taxes, and okay, you've got a profit after tax. You put a profit and loss statement. No problem here. Then they have some transfer to the retained earning account. Okay, I suppose you could put it here. Nothing that wrong with that. Here's what's wrong. The tax calculation should be part of the profit and loss. In project finance, that's the only reason you do it. Now, in this tax calculation, there were some absurd things. Here, first of all, this is such a good little example of why you'd never do this. There were some things like here, this is an input. This is some kind of input that you can, from year 6 to 10, some kind of alternative minimum tax or something applies. Tried to understand that from looking at the model. And then in the input, that's the summary page, excuse me, in the input, which, let's press Shift Alternate C, and let's not include the columns, and let's do the inputs right. Okay. And in the inputs, somewhere near the taxes, which isn't arranged near the taxes, it says the holiday in section 80-IA is from 10 to 15, but there's nothing attached to these inputs, and they didn't, and instead, this is such a basic crime that it's hardly worth saying. They didn't use those inputs to, assign a true and false variable. Excuse me, I'm getting so kind of emotional. If you do any of these things, there should be a checklist. Don't do this. Don't start talking about best practice crap. Don't go to some website and say, oh, this is best practice. You did something wrong. Don't do that. But just know what's absurdly wrong to do. Know what's a crime. Now, here's the real crime of this. In the cash flow statement, what is this? Sources of cash, uses of cash, CapEx, which who knows where that came from. This CapEx came from the difference in the assets. And we have a different formula in this column than that. What a crime that one is. And then the repayment of the debt is the difference between the debt balance. The cash flow statement should, in a project finance model, obviously come first. And then they've got this interest on the balance, which is they don't even show what the balance is at first, and that's zero anyway. I'm gonna zero that out. That's that by taking it on the average balance, you got a zero, and now we've seen where the circular references come in, and the only thing to really do is now really work a little bit harder on the. I'm sorry. See the interest during construction one isn't fixed. Okay, now um, then they have a cost sheet, and this cost sheet is supposed to do some fancy LCOE analysis. And if you can compute the LCOE, levelized cost of electricity, by taking the cost of the project, the present value of the O&M, present value of the taxes, and then divide it by the present value of the generation. And you should use I have to be really careful. If there are no taxes, you use the pre-tax project IRR. After taxes, I have to check whether you'd really use the after tax. But instead of doing that, you just simply take a discount rate. If the government gives you a discount rate, you take the NPV of the revenues divided by the NPV of the generation. You could also take the NPV of the operating cost divided by the NPV of the generation and get the levelized cost of O&M. You can do all that. It takes like a minute. And instead, we have a whole big formula for that. And then then the ratios. Oh my gosh! Look at these ratios. Take the DSCR. We have to take profit after tax, add depreciation, add some kind of tax savings. You add all the taxes. It's not so complicated. You do this right after you do the cash flow statement. This is part of it's part of the cash flow analysis, part of the definition of project financing being. I'm looking at the television. They say Alzheimer's. I hope I don't have Alzheimer's. Maybe I do. I shouldn't have said that. This is part of the cash flow analysis. It's part of the definition of project finance, that project finance is cash flow based. Project IRR should be computed right after you compute the project IRR. I don't know what happened to this. An equity IRR should be right at the end. No fancy crap. And then this phasing analysis. Okay, let's try to look at the phasing analysis. Error number one. They had the S-curve assumptions that are related to CapEx. Please, 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 these better be in the assumptions page. How could you not put them in the assumptions page and put them next to the CapEx in the assumptions page? Ordering the assumptions is a crucial kind of thing. Please, if you're advanced, I hope you've turned this video off. If you're new to this stuff, be very careful. And then this, clearly there's some error with the interest during construction. And here's the error that comes from this. It is unbelievable. You start with the circularity. You start with 5 things. What's the size of the debt? To get the size of the debt, you do a summary, sources and uses. And then you see how we're going to fund the debt. And you put some analysis in, some debt first, equity first, and all that. And then you make a sources and uses during construction. You have 2 cash flow statements. If you don't understand this, you're not supposed to make them all. 2 cash flow. Cash flow before COD. Cash flow before your world changes. Cash flow before you were born, before you were married, whatever analogy you want to use. And then cash flow waterfall after you start repaying things, hopefully. And the cash flow before is all negative, the cash flow after is all positive. And those should be kind of combined, not combined, but then you can pick out the equity IRR. So I'm going to turn the video off and fix this one just for a minute. Well, I didn't fix it. All I did, I was kind of lazy. All I did is zeroed out the interest during construction. So we know where the sources, all of the kind of circular references come in, and uh, and we see kind of how the model should be structured. Now I'm turning off this video, and in the next video, I took this model and illustrated how it should be fixed. So the second part of this is very much related to the first part, and I'm just illustrating what a properly structured model should look like, and I'll kind of go back and forth. I wanted to make two videos out of this. Okay, so this is the end of the first part.